The US tax system confuses most people, but today I'm going to break it down step by step in plain English, so you finally understand how it works and how it affects you. If you're new here, I'm Yama, a licensed tax pro. On this channel, I simplify taxes to help you handle your tax matters with confidence and avoid costly mistakes. So let's dive into the video. The US tax system is structured in a way that involves federal, state, and local government agencies that collect money through various taxes, such as income tax, sales tax, and property tax. The tax money is used to fund a wide range of public services for the benefits of US residents, including roads, schools, healthcare, and more. At the federal level, the IRS, which is short for Internal Revenue Service, is the agency responsible for collecting taxes and enforcing tax laws. The core tax law in the US is called the Internal Revenue Code, or Title 26. It is thousands of pages long, but you don't need to read it all because the IRS provides simplified instructions and forms to help you comply with the law. At the state level, each state has its own Department of Revenue or a similar agency responsible for enforcing the state tax laws, as well as collecting state income tax, sales tax, and other state-specific taxes. For instance, California has multiple agencies, including the Franchise Tax Board that collects personal and corporate income taxes, and California Department of Tax and Fee Administration that collects sales and use taxes, as well as variety of special taxes and fees. At the local level, tax collection is handled by various offices within counties and cities. For example, a county's assessor office handles the valuation of properties, including real estate and business equipment, to determine how much they are worth for tax purposes, while a county's treasurer office collects property taxes. For instance, in California's Santa Clara County, the assessor's office determines the value of all taxable property, and the Department of Tax and Collections is the agency responsible for mailing out tax bills and collecting those property tax payments. At the individual level, the main type of tax most of us deal with is the income tax. Income tax is the money that comes out of what you earn, whether from your job, a side hustle, a business, or investments. Most people in the US pay two types of income taxes: federal income tax and state income tax. Federal taxes apply to everyone, but state income tax depends on where you live. There are 9 states that do not collect a state income tax. Those states are listed on the screen. If you live in one of these states, you generally only deal with federal income tax. However, there's one important exception. Washington does impose a 7% tax on certain long-term capital gains. That 7% does not apply to wages, interest, or dividends. Other than these 9 states, if you live in a state like California or Virginia, you will be filing both federal and state income tax returns. The US uses a progressive tax system. That means you don't pay your highest rate on all of your income. Your income is actually sliced into different levels or brackets, and each slice is taxed at a different rate. You only pay the higher tax rate on the portion of your income that falls in that specific bracket. Let me make this crystal clear for you. Here are the federal income tax brackets provided by the IRS for a single filer for tax year 2024, 2025, and 2026. As you can see, the threshold in each bracket changes every year. Now, to illustrate this, let's look at an example. Let's say James has made $60,000 of taxable income during the tax year 2025. With $60,000 of taxable income, James falls into the 22% federal tax bracket. But he doesn't pay 22% on all $60,000 taxable income, not even close. This is one of the biggest things new filers misunderstand. Here is how James's federal income tax is calculated. He pays 10% on the first $11,925, which is $1,192.50. He pays 12% on the next $36,550, and we arrive at $36,550 by deducting $11,925 from $48,475. Now, $36,550 multiplied by 12%, we get $4,386. Next, James pays 22% only on the remaining portion of his taxable income, which is $11,525. And this comes from deducting $48,475 from James's total taxable income of $60,000. Now, by multiplying 22% on $11,525, we get $2,535.50. So James's total federal income tax is $1,192.50 plus $4,386 plus $2,535.50, which is equal to $8,114. Now, $8,114 is far less than just multiplying 22% on his taxable income of $60,000, which is equal to $13,200. This brings us to two key terms: marginal tax rate and effective tax rate. Your marginal tax rate is the highest tax bracket you fall into. In James's case, it is 22%. Your effective tax rate is your total tax divided by your total income. In James's case, 8,114 divided by 60,000 is equal to 13.52%. So don't ever be afraid to earn more money thinking it will push you into a higher tax bracket. That is a myth. Earning more will always result in more money in your pocket. When it comes to filing taxes, you will need to file both federal and state tax returns, unless you are in a state without income tax. A tax return is simply the set of forms you file every year to report your income, your deductions, your credits, and to calculate how much tax you owe or how much refund you should get back. Most people file their taxes once a year, and the deadline is usually April 15th. You will use forms like 1040 for federal taxes and your state's specific form for state taxes. For instance, Form 540 is used in California to file California individual income tax return. Remember, it's important to file your tax return on time to avoid penalties and interest. And if you're not sure how to file your tax return, tax software like TurboTax can help you do it step by step. Or you can hire a licensed tax preparer. On this channel, I will be preparing lots of tax returns through TurboTax Online, so stay subscribed for that. Okay, so why should you care about any of this? Why bother learning about the tax system at all? Let me tell you, acquiring tax knowledge is essential. It is the difference between overpaying and legally keeping more of your hard-earned money. Understanding taxes is like knowing the rules to a game. If you don't know the rules, you are probably leaving money on the table. Every year, millions of people miss out on tax deductions, credits, and refunds just because they don't know what they are entitled to. That's why it is critical to file your taxes every year. Filing your taxes isn't just about complying with the tax law. It is also about reconciling your income and taxes for the year. This is where you either pay what you owe or claim back what you have overpaid. So putting it all together, here is how the annual tax filing process generally works in 3 simple steps. Step 1. Gather your documents. Collect everything that reports your income or expenses for the year. Your W-2s, 1099s, interest forms, investment statements, and any documents for deductions or credits. Most of these documents arrive between late January and early February. Step 2. Prepare and file your tax return. You can file your taxes either electronically or by filling out paper forms and mailing them to the IRS and your state. If you prefer to e-file, you can use tax software like TurboTax or H&R Block. You can also choose to hire a licensed tax professional to file for you. Generally, e-filing is faster and more accurate than mailing out paper tax return. Step 3. Pay or get paid. After you file, if you overpaid, you will receive a refund from the IRS, your estate, or both. However, if you owe tax, you should make a payment before the deadline. Usually, it is April 15th. Alright, thank you so much for watching this video. This channel is all about handling taxes the right way, so I suggest you stay subscribed. See you in the next video. Bye bye and take care.